Okay, great. Well, thanks a lot, Roland, and thanks everyone for dialing in today. The numbers are still climbing. Looks like we've got a really good house of attendees tonight. It's been over 4 months since I presented last to the Share Magazine event, as this we're doing tonight. Lots changed since then, including the gold price, which is up 10% since then, and our share price has gone up, I think, about 50% since the last presentation in May. So things are looking up, despite a pretty gloomy scenario in the global economy. All good things for gold. My name is Zurrin. I've been the CEO of Shanta Gold for the last 3 years. Over that period, the share price, the market cap's done really well, but we still continue to trade on only 2 times operating cash flow. So we think still a lot of work to do to get the re-rate and get what shareholders deserve. Just as an introduction, Shanta is the 3rd largest gold producer in Tanzania. We're a good company. We're behind Barrick and Anglo Gold, and we have a fantastic growth engine in our portfolio, particularly with this acquisition we just announced and completed in Kenya. On to slide 3 here, which is a really short phrase, but packed with a lot of big words. Now, what I want to get across to you is the following. Over the last 10 years, I've been spending time in developing markets in North Asia and in Africa. And what I found, and this is really part of our DNA at Shanta, is that we take a really long-term view with what we do and where we do it and who we do it with. And that means we have to be disciplined. We have to think about not what gets us the next quick win next quarter or next week or the next 6 months. We've been in Tanzania for 20 years. We want to be there for another 20 years. I think we can. And the only way to be there sustainably for a long time is to make sure your host countries, your communities, and also your shareholders benefit. It has to be a tripartite, and everyone has to get some value out of the company. So that's really kind of the way we think. I think it's really important to set that out early on. Now, on to slide 4. Do we actually walk the talk? How do the communities benefit? Well, I put a few initiatives down here on the slide. The takeaway here really is we're aligned with the way the government of Tanzania wants us to make sure our communities benefit. We align with water, employment, healthcare, and education, and we do a lot of things right in the communities, and the communities want us there. Notwithstanding, 40% of our employees also come from within the surrounding communities within 5 kilometers. So we've got a really good relationship with our local stakeholders. Our central government, the Tanzanian government, loves the fact that we pay a lot of tax, and soon it will be the shareholders' turn to benefit from Shanta, and we'll get on to that in a second. In terms of safety, now listen, Shanta's a mining company, but it's not really a mining company. It's a business. We happen to produce gold. That's the way to think of this. We are a business first and foremost. We happen to be in the gold mining industry. I mean, without a doubt, the way to think of Shanta is we can't be in the extractives industry and use that as an excuse to be unsafe. It just doesn't work like that. Now, the track record of our safety is paramount. We've now hit 33 months without an LTI. People often ask me that. How do we get through that? What's the secret sauce? There isn't one. We structured in terms of enablers and KPIs, and every single one of our employees is responsible for doing walkthroughs on a regular basis across the operations. We try and find the problems or the issues before they become safety concerns. And that's what we do. We're proud of it. We take care of our people. Now, in terms of the actual company, on slide 5, I believe, as I mentioned, we're a business and we happen to mine gold. So the good news here is we do it profitably. We are a profitable gold company, and a lot of junior miners can't say that. We can. We're not an exploration company. We're not banking on the next drill hole to be a big success. And swing for the fences. We do this disciplined, long term, and we do it profitably. We've been in Tanzania now for 20 years. That's a long time. We know the country really well. We know the stakeholders, and they know us, which is really important. There's a level of trust and transparency, so that's key. We've been producing gold for 8 years. You don't, I'll promise you, you don't get to produce gold overnight and be a big success at it. It takes a long time. You have to get rid of the kinks, and there are teething issues. Now we've got 700 employees, and we have a formula that works. So it's it's successful. And then finally, we have 3 assets across 2 countries following this acquisition in Kenya. Now, just last week, we've announced an update to our reserves. We now have 653,000 ounces of gold reserves, all above 3 grams per ton on a blended basis, which is very good news for us. There's a lot of intrinsic value, and it also happens to be the highest reserve number we've ever announced as a company. So that's also good news. We're on track to produce 80 to 85,000 ounces of gold this year, again, which I think will step up to about 115,000 ounces when Singida gets off and running, hopefully in 2022 is the latest numbers. And of course, I must mention we own what's believed to be the highest grading plus 1 million ounce gold deposit in Africa. Now, there's so much intrinsic value underpinning Shanta. These things don't get noticed overnight, they get noticed over time, and value re-rates. Now, what I must promise you is the following: be patient. I mean, I remember speaking to a shareholder, it wasn't even 24 months ago, and they complained about buying the shares at 4.2 pence a share, and then the following day or a couple of days later, it went down to 3.8 pence per share. That's hard to complain about when we're trading at over 17p today. Be patient. Things, value does re-rate. Now, if it doesn't re-rate naturally, there's 2 ways to make that happen. One is through dividends, returning them to shareholders. The other is through M&A, when it's strategic, takes a view on your own value of the company. So there's lots of value to play. And in fact, just over the last 3 or 4 months, we've had 8 new institutional investors. Not are all on this list. Some are small, but they are buying. And we've also had some increasing buyers from our existing shareholder base. So that's quite comforting to see some of the smarter investors in the sector and some generalists coming into the stock. Now, of course, we're going to have sellers, and we mustn't be worried about that. A lot of shareholders we've had on the register have been around for a long time. Portfolio managers need to make their own decisions, sometimes beyond their own control. It doesn't keep me up at night. You're going to get sellers and you're going to get buyers. That's what makes a market. So we're absolutely convinced we've got the right ingredients for a successful story, and the value will re-rate over time. Now, just cast your eye here on the EBITDA number for 2020. $69 million is what we've said is on an annualized basis. Just remember, that's on $1,533 an ounce gold price, 20% lower than where it is today. So you can do the math. Now, in terms of this page here, the numbers and the graph to look at are really on the right-hand side, and I'll tell you why. Free cash flow number is really what matters to all mining companies. Don't be distracted by all sorts of slicing and dicing. The free cash tells us how much money can be actually returned to investors or reinvested into growth. Now, I happen to think that both of those things are very important when you're looking at the business case of a mining company. Historically, Shanta has used all of its free cash, and had to borrow some historically from previous management teams, to invest in the growth. I think that story needs to change, but we still have a little bit of work to do to make sure we can split that pie across returns and growth. Onto the portfolio here, we have 3 assets, which you'll see. And what I can tell you is this: last week we published our reserves and resources, and as I said earlier, there's a lot of value across these 3 assets. New Luika gold mine, let's start with that one first. We've just increased the mine life now on a reserves basis to 2025. Bear in mind the following: 410,000 ounces of reserves, but another 530,000 ounces of resources outside the mine plan, but on the mining licenses. What does that really mean? It means that Those are the areas we're targeting to convert into the mine plan. How do we convert? We drill. Have we been successful drilling and converting ounces into the mine plan historically? Yes. Now let's go back to 2014. In fact, a year earlier in 2013. Since 2013, we've spent collectively $23 million on exploration. It's not a lot of money actually when you benchmark it. We've converted 473,000 ounces into reserves using that money. So this is kind of giving you the longest track record of looking at this. What that actually means is it's cost us $50 an ounce to convert ounces into the reserves in the mine plan. $50 an ounce compared to $1,950 an ounce selling price. Pretty good return, I'd say, and that's where we spend that's our top priority in terms of spending money. So if we can do that with our resources outside the mine plan, the arithmetic shows we'd be able to live on to 2029 at New Luika. Again, I'm not saying that'll happen. That's just the arithmetic, and we're going to invest in the right areas. The second project, Singida, it's a development project, standalone in Tanzania. I'm sure you've heard all about this one. I won't say much more because we promised we'll have an update out before the end of the quarter. And we have now reserves on the project. I would be surprised, on the plans we're looking at, I'd be surprised if this wasn't around, well into the 2030s once it's up and producing. And then finally, the West Kenya project. Now, a couple of key facts on this one. Again, I already said, one of the highest grading gold deposits, over 1 million ounces in Africa. Acacia, who we bought it off of, Barrick, had spent $63 million on this asset since 2012, I believe. We paid them 20 cents on the dollar to take it off their hands, roughly about $14 million. So that's pretty attractive. I think that's a good kind of assessment of a good deal for us. Now, again, the quality of the resource is what really gets us excited, and I'll give you a few examples in a minute to take you through that. Now, let's just look here at the new Luika gold mine for a minute. Now, last week we announced drilling results at the Luika and the Black Tree Hill deposit. These are 2 of 7 deposits within the mining licenses at New Luika Gold Mine. They're all separated by about 3 kilometers. There's a plant in the middle. Anyway, the point I'm trying to make is as follows. The area highlighted here, or kind of squared off by this dark red line, is the area where we've added new reserves at the Luika deposit. We didn't know if this was going to happen, but we looked at the structural integrity. We had consultants. We looked at soil samples. We looked at the way the mineralization was being constrained, and then we took the plunge and we drilled, and we got some incredible results. We spent, between Luika and Black Tree Hill, we spent $750,000 in drilling, and we added 75,000 ounces of reserves. Again, it's not a game changer, but it's yet one more year of mine life, and at these gold prices is highly valuable. So this area that I've cordoned off here in red points to the area that, pretty modest drilling completely opens up the Luika deposit. Then you can see on the bottom of the slide, those numbers. Those are the planned drill holes for the future. Can't tell you when we're going to get in there, but probably within the next, I think we said the next 6 to 9 months. We're going to try and drill those, and we do it systematically and we do it carefully because we're not one to spend money irresponsibly. Let's look at the Black Tree Hill deposit, the long section here. Again, you'll see there was the kind of top level between the 925 level and the 1,000 level. So those are meters above sea level. We then started plugging some holes down, another about 75 meters below the existing reserve base. So this is called 150 meters below surface. And lo and behold, mineralization proved to be economically viable. It's in the reserve case. It's in our life of mine plan. Not expensive, highly valuable. And so the point I'm trying to make is this is repeatable. we can do this again and again and again across our mining licenses. And this is without having to even go across 1,200 square kilometers of regional prospectivity. So we're really, we're confident that the mine life will continue to extend, and we hope investors will start to look beyond just the reserve case. Now on to the West Kenya project, then I'll finish with the catalyst. Let me just boil this down to you, what this actually means. So the West Kenya project has a resource inferred 1.2 million ounces at 12.6 grams per ton, very high grade. Now, I think it was about a year ago I presented and I explained the significance of grade. And a lot of people, they know it's important, but they don't quite, it's hard to kind of put some numbers and some ideas around it. Let me just take you through this follows. Picture a 40-ton truck. These are like one of those conventional, decent sized dump trucks that you might see, driving around the M25 with a load of gravel or something like that. That's what we have driving around our mine site, these 40-ton trucks. Now, if you have 40 tons and it's running at, say, 4 grams per ton, that gives you the equivalent of about 5 ounces of gold. It's just the arithmetic. This is what happens. So at $2,000 an ounce, you're looking at about $10,000 of gold contained in that material on the truck. So roughly about $250 a ton. Now, if you double the resource grade, or take it up to 10 grams per ton, say for instance, this is lower than the actual resource grade at the West Kenya project, you've all of a sudden taken that $10,000 of gold in your 40-ton truck. It's also all of a sudden now become $25,000 of gold in that same truck. Same amount of work, same philosophy, same equipment, same people, just getting more gold. That's the power of grade. Now, it's kind of every farmer's dream at the start of the season to kind of lay out the seeds and hope for a really profitable harvest. I think we've got it here. This is really interesting because of the grade, and the grade starts 18 meters below surface. We have 10 meters grading 17 grams a ton, 18 meters below surface, and it zips all the way down, go down 6 football fields, head to toe, all the way down 600, 700 meters below surface. You're still getting, let's look at this hole, 83, 6.4 meters, grading 32 grams per ton at 670 meters deep. It's all there. We need to do more drilling, but we've got a really good starting point for this project. It has the hallmarks. Now, finally, just to close off on the value catalyst, we've been really busy and there's still more to come. So we've talked about Singida economics, Singida financing, and the Kenya scoping study. That's what's keeping us busy right now. Those are 2 out of our 3 projects that we've got to focus on, and we've made good ground. We're gonna get some updates out. I said this quarter, next quarter, when we're ready. And we think it'll be positive. So, but you can make your own decisions when we put our press releases out. Now, I think another point worth making, Liberum, which is our new broker, and that we've had to take on a new broker because Numis has withdrawn from the mining and oil and gas market. That's it. That's the reason why we switched to Liberum. So we've taken them on. They've taken us on. It's a good relationship. We like them. We've known them for years, and they put out I think a decent, really good initiating coverage report today on Shanta. I think one of the news wires reported it was 23 pence a share at the target price, to be expected. But I think what they do most specifically is they outline the arguments for why Shanta is interesting. They outline the risks, and then they outline the potential for upside. What could be the levers to get a higher value. Now, of course, the gold price is anybody's guess, and from the conversations I'm having with pretty smart people in the U.S., it looks like family offices and many others are positioning for what could be a pretty ugly U.S. election in November. So stay tuned. Let's see what happens to the gold price. With that, I'll open up to any questions, and hopefully I can answer them. Thank you very much.
Okay, Eric, thank you very much indeed. Thank you for your presentation. Quite a few different themes of the questions, so apologies if we kind of jump around from one to another. a question that came in early, and he did address it to some degree, and it was about some of the institutions that have come in, some of the institutions that have gone out. From some of the recent sales, are you able to comment whether it's your understanding if it's their intentions to exit completely, or this is just a selling down?
Yeah, no, it's a good question. I mean, I can't speak for portfolio managers. I really can't. I mean, it's not my job, and it's not my position to. We hear a mix. I mean, a lot of the shareholders we talk to them regularly. They see the arguments, they see the reasons why they want to continue to be shareholders of Shanta. They have constraints around their own funds, and typically, it's quite interesting. Ironically, one of the key reasons we've heard from I think two key investors specifically is they have to sell because the value of Shanta as an entity within their own fund has breached UCITS limits. So because the share price has gone up kind of 6 times in the last 3 years, or 5 times or whatever it is, they now the position becomes too big in the overall fund and they're forced to sell. Anyway, I mean, I can't comment on what the investors will do. All I can do is explain the story.
That's fair enough. Sangida financing, will equity be used to finance Sangida?
Sorry, can you just repeat that? What will be?
Will equity be used to finance Sangida?
No, we don't have. We've been pretty clear about that, and what we've said all along is we're looking at asset level financing for Singida. And one of the options we looked at was this local listing. It's one of many options we're considering, including another option would possibly be local debt and asset level financing. Anyway, what we're going to do is we'll be committed on an avenue for Singida financing, and we'll communicate that when we're ready.
I'm going to read this question out as it's stated. If life of mine at New Luika is now 2025 with the latest reserves, what was the life of mine before the increase in reserves? And if New Luika life of mine based on 80 to 85,000 ounces per annum?
Yeah, no, really good question. So the previous life of mine was 2024. That's what we published in one of our RNSs last, I think it was in November. We said that was the official mine life 2024. Now it's gone up to 2025. And the way to think of it is the reserves are 410,000 ounces. You have to factor in dilution, and recoveries, call it 91%, divided by whatever number you want to assume per year, gives you your annual production per year and the number of years. So, I mean, that's the kind of most crude way of working out number of ounces per year and number of years on a reserve base. But I do caution you, please consider the resources because we have a track record of converting them to reserves.
And on that, are the resources reserves now at a point, do you think, whereby your size makes you attractive to be taken out? Are you sufficiently impactful for a major or for a larger company?
Yeah, I wouldn't. I mean, I can't comment on that really. Again, I mean, we don't have any discussions or anything with anyone. Obviously, everyone can make their own judgments on that. Shanta's relatively small for a major, if you consider a major being anyone over kind of $10 billion. But there's a plethora of other companies, and gold seems to be the hot commodity these days. So it's where the animal spirits are. You've seen what's happened to, I think it was Cardinal Resources, 5 or 6 bids between groups. So anyway. As I said at the start, value will normalize, and there's typically 2 ways to do that: returning capital or M&A.